What if I told you that one of the world's biggest companies, Amazon, might be hiding an untapped potential worth over 117% in undervaluation? Yes, the very same Amazon that dominates e-commerce, revolutionizes cloud computing, and is now taking over digital advertising. While critics argue that its growth is slowing, others believe Amazon's best days are still ahead. Let's dive into the numbers, the strategies, and the future that might make Amazon one of the biggest investing opportunities of the decade. Amazon, the tech behemoth that redefined online shopping and pioneered cloud computing, is at a fascinating crossroads. With its vast empire spanning e-commerce, physical stores, subscriptions, advertising, and AWS, Amazon Web Services, it's easy to think Amazon has peaked. Yet, beneath the surface lies a compelling story of hidden potential and strategic shifts that could reshape its future. From its rapidly growing third-party marketplace to the untapped goldmine of digital advertising and its continued dominance in cloud computing, Amazon's business model is evolving in ways that might surprise even its most loyal investors. In this analysis, we'll uncover the numbers, the strategies, and the vision that could make Amazon's stock one of the hottest opportunities on the market. Over the years, Amazon has faced intense competition in every sector. Giants like Walmart in retail, Netflix in streaming, and Google in advertising have fought tooth and nail to defend their turf. Despite these battles, Amazon has continued to push boundaries, often taking risks that leave analysts puzzled. Recently, Amazon's strategy has shifted focus to segments that promise higher profit margins. The third-party marketplace, where independent sellers list products on Amazon, is growing faster than ever. AWS continues to lead the cloud computing market, while Amazon's advertising business is quietly becoming a powerhouse, rivaling Google and Meta. However, not all of Amazon's ventures have been a resounding success. Experiments like physical stores have shown slow growth, raising questions about whether Amazon's resources are being spread too thin. Let's deep dive into its business segments and a closer look at its potential future. Take Amazon's e-commerce segment, for instance. While its first-party retail business, where Amazon sells products directly to customers, grows at a modest pace, the real star is its third-party marketplace. This segment, where independent sellers use Amazon's platform, is seeing explosive growth. In fact, in 2023, this part of Amazon's business grew by 19%. Why does this matter? The profit margins for third-party sales can far exceed those of direct retail, making this a goldmine that's just beginning to show its potential. Then there's AWS, the crown jewel of Amazon's portfolio. AWS is not only the leader in cloud computing, but also a key driver of Amazon's profits, with projected annual growth rates of up to 20%. And let's not forget Amazon Advertising, a relatively quiet contender that's rapidly gaining momentum. While giants like Meta and Google dominate digital ads, Amazon's advantage lies in its unique data. It knows exactly what customers are searching for and buying. In a market expected to grow at a CAGR of 15.5% until 2030, Amazon's targeted ads are capturing more market share than ever. So here's the question. Is Amazon's current valuation overlooking these high-growth opportunities? Or are the risks too high for a higher valuation? But after analyzing Amazon's diverse business segments, the real story emerges through two valuation scenarios: the bear case and the bull case. These scenarios reveal just how much hidden potential Amazon. In the bear case, growth slows, and Amazon struggles to keep up with competitors. The first-party commerce business grows at a modest 3% annually, with slim profit margins of just 5% by 2031. Even AWS, the company's most reliable profit driver, grows a conservative 15% per year. When all these segments are combined, Amazon's stock is valued at approximately $150 per share, implying that it's currently overvalued by 20%. For the skeptics, this case paints a sobering picture. Amazon, while still strong, could be entering a period of stagnation. But the bull case flips this narrative entirely. Here, Amazon leans into its high-margin segments, achieving remarkable success. The third-party marketplace grows at an explosive 15% annually, while profit margins soar to 25%. rivaling competitors like eBay. ADLS maintains its dominance, growing 20% annually and sustaining margins as high as 35%. The advertising segment becomes a goldmine, with profits climbing to a staggering 45%. Under this scenario, Amazon's stock valuation skyrockets to $318 per share, translating into an undervaluation of 117%. The truth, as always, likely lies somewhere in the middle, but the key lies in how well Amazon executes its strategies in advertising, AWS, and the third-party marketplace. Looking at the last year of our bull case scenarios, we can clearly see on what segments Amazon should focus on in the upcoming years. The biggest EBIT contributors are the cloud, advertising, and third-party segment. These should be the focus segments for Amazon in the following years. I also would prefer if Amazon starts to stop experiments like the physical stores and focus on their core growth catalysts. With our bear and bull case analysis, we get a mispricing in the range of 20% to 117%. I nevertheless think that the current valuation is still a very good entry point into Amazon, considering that the assumptions we made are very realistic and could very well exactly play out as expected. That is why I currently rate the stock a strong buy, with a medium-term price target of $220.